Hi everyone, welcome to today's video. So let me start today's video by talking about two very interesting examples. Please listen to this very carefully. You will learn a lot of things. So the first example is of a company called as JK Tires. And what you will notice is that the sales of the company has generally been going up. So from around 2016 onwards, the sales have been on a general upward trending path. Also, the net profits have been typically growing. For example, in 2017, the profits were 375 crores, then they dipped, then they have been rising, etc. etc. Now, what you will think is that, okay, sales are high, profits are also there. And if you would have purchased this stock in 2017 when the profits were very high, let's see what the stock performed as. So let's go to the entire pricing chart. And what you will notice is that in 2017, the stock price was trading at roughly 170, 180 range. And right now it is trading at roughly 125, 130 range. So in a period of 5 years, the stock has given negative returns. This is despite the fact that the sales have generally gone up and the company has been profitable. Now you might say that, okay, there must be some kind of an industry issue, therefore the company was suffering. Okay, so let me pick another example from the same industry, and the stock is called as LG Balakrishnan. And let me run the same analysis here. So let's look at 2017, 2016 data, and the sales have been generally going up. No major problem there. In 2017, the profits were 71. Then the profits danced around and suddenly there was a spike in profit in 2022. But if you would have purchased this stock back in 2017, let's look at the stock performance. So let us take a look at the 2017 data. So you can see that, hey, the stock was trading at roughly 350 rupees. Right now, this stock is trading at roughly 730 rupees. So in a matter of 5 years, this stock more than doubled and JK Tire stock actually went down. So why exactly is this happening? The answer lies in Warren Buffett's $1 test. This is a very important aspect for you to understand, because we as normal retail investors, what we typically do is that we look at revenues, we look at profits, and then we go and invest in a company. And many a times those revenues, profits do not translate into increased stock price. So this video is very important. On this video, I am going to, number one, help you understand what Warren Buffett's $1 test is. And what are some of the good stocks which meet this particular criteria by Mr. Warren Buffett? So that's one. Second, I'm going to help you understand why investing in India right now might be a very sensible golden opportunity which can literally double our wealth in the next few years. So these two are the primary points that I will speak about. Also, a very big shout out to our sponsors for today, which is Small Cases. In case you're starting your stock market investment journey or you are bullish on certain themes, I'm linking some of my favorite small cases in the comment box. It's an excellent way of investing your money, especially when you're in a job and you might not have a lot of time in terms of scanning and researching stocks. So do take a look at some of my favorite small cases. It is there in the description box. So let us kickstart the discussion, and first and foremost, let us systematically understand what is Warren Buffett's $1 test and why is it important for companies. So here is the theoretical definition of what Mr. Buffett has said. Let me break it down in very easy to understand language by picking a simple example, and then I will come back to the definition. So let us pick the example of ITC, and this is a hypothetical example. So let's say that ITC does its business. So it starts selling chips, it starts selling cigarettes and bunch of different things. And within a year, what it does is that it generates 100 rupees of profit. So it's a hypothetical company generating 100 rupees of profit. Now the company gets two choices in terms of handling its profits. So the first option is that it can give out dividends. For example, you might have seen that ITC gives out a lot of dividends. So let's assume in this hypothetical example that ITC gives out 40 rupees of dividend. Now how much money is left with ITC in terms of profit? 60 rupees, because 40 rupees has been given to the shareholders and they are getting some money in return. So they are happy about it. Then what happens to this 60 rupees that is left? This is called as retained earning. Why retained earning? Because this is the amount of money that has been retained by a company called as ITC. So let's move on to step 2. What happens then? So now ITC has 60 rupees of retained earning. What becomes the goal of ITC in terms of utilizing this 60 rupees? So it will go hire more people, create new factories, launch new products, etc. etc. And it will try to utilize these 60 rupees of retained earning efficiently. Now, let me ask you a very simple question, and please comment below that what is the goal with which ITC is spending this 60 rupees? It is spending the 60 rupees with the viewpoint that, okay, if we are undertaking and expanding our business, then whatever 60 rupees of investment we are making right now, it comes back to us in form of more profits. So I hope this is a very simple example. Now continuing with the entire story. So what Mr. Warren Buffett says is this. Now ITC is retaining this 60 rupees of profit, but at some stage this should come back to the shareholders in terms of stock market price increase. Now think about it practically. how are you going to make money as a stockholder in ITC? You are making money either through dividends here when company declares the dividend, or you are going to make money when the stock market price of that particular stock increases. So these are your two routes. So if a company is giving you money in form of dividends, it makes sense. But if a company is retaining its profit, then one could argue that the goal of the company should become to increase its stock market price so that investors also make money through it. And according to Mr. Warren Buffett's $1 rule, and here is the rule again for you to go and parse through the definition, it simply says that, hey, if the company is retaining $1 of earning, then it should translate into increase of $1 in its stock price at a certain stage. If that is not happening, it means that it is a bad company. Now, how do you run the valuation? So let me run the valuation on the two examples that I had started the video with. So in order to run Warren Buffett's $1 test, what you need to do is that you need to compute the cumulative EPS. EPS means earning per share. And here is the technical definition of EPS. You don't need to go and learn a lot of finance. Just simply understand the meaning of EPS. EPS simply means earning per share. For example, in the ITC hypothetical example, it was 100 rupees of profit. So let's assume that ITC in the hypothetical example had only one share. So what will become the earning per share? It will become 100 rupees. So we calculate the earning per share of Balakrishna Industries and JK Tires. So this is what the cumulative EPS comes out to be. Another technical way of doing it would be that you take a look at the profits of the entire company and divide it by the number of outstanding stocks that are there for that particular company. So this will give you earning per share. So now moving on, and let's continue with the stock price. So here you can see that, hey, the stock price on July 18th and between this period, what was the stock price increase? It was 1068 for Balakrishna Industries. And if you divide 2 by 1, then you get the parameter for Warren Buffett's $1 test. And here you can see, since the change in share price was positive, we were getting some positive value here, and this is what we want to see. Here we are getting 0 because the change in stock price itself was negative. Now the reason why I'm showing you this computation is that this can allow you to create a list of Nifty 50 top stocks that meet this Warren Buffett's $1 criteria. So here is the entire list for you, and I will take you through some good stocks here. For example, if you consider and run the same analysis for Asian Paints, you will see that this number comes out to be 28, which is a fabulous number. Again, if you go to something like Hindustan Unilever, this number comes out to be fairly large. Again, if you go to something like Nestle, this number comes out to be fairly large. So I will link the chart here and you can go and study this chart. This becomes a very important parameter if you're trying to identify good companies. This can definitely play into your investment thesis. Now, another key point that I would like to tell you from this chart is this. For example, if you take a look at Maruti Suzuki, it has delivered negative stock price. Similarly, if you take a look at Tata Steel, it has done fairly badly. Similarly, if you take a look at NTPC, it has not done that great. If you take a look at ITC, it is close to 0 right now. So this data is for last year, and ITC has started giving a run up in the last 3-4 months. So this data might not be relevant for a stock like ITC. Now, before discussing why this parameter is very valuable for the Indian stock market right now, let me talk about some limitations of this Warren Buffett $1 rule. So the first key limitation of $1 rule is applicable to companies like ITC, that there can be muted times for certain companies when they will not give run up despite excellent financial performance, and then suddenly they will start giving run up. So from that particular perspective, you might miss out on investing in some good stocks because you will take a look at number 0 for ITC and you will not invest in it. So this is the first key limitation. The second key limitation of this Warren Buffett rule is that you might pick the period that supports a certain type of stock. For example, on our study, we picked the period 2017 to 2021. During this time, Nestle stock has been on an uptrend. Let me show you the chart also. So from this period onward, it has been on an uptrend like never before. So this can give skewed performance. So therefore, you can see a very high number for a company like Nestle. So then you will say that, hey, what's the point of using this formula? Actually, this formula is very good in terms of understanding the capital allocation efficiency of a company. Now, what is the meaning of capital allocation efficiency? So let me take you back to that hypothetical example of ITC. So there, the company was retaining 60 rupees of profit. Now the stock price will only rise if people believe that the company can use that 60 rupees very, very efficiently. So that in technical term indicates company's capital allocation efficiency. So it's always good to invest in companies where the market believes that this company has the power to allocate capital efficiently. So from this list, you can easily understand that what the market believes is the capital efficiency of different Nifty 50 companies. And as per $1 principle by Mr. Warren Buffett, these are the top 5 stocks that will fit this category. Now comes the second and the more interesting part, that why do I feel that this $1 rule will become more favorable for Indian markets over time. This is very important aspect to understand, because if you're doing index investing or if you're only investing in blue chip companies, it becomes a very important parameter for you to understand systematically. Okay, so let me tell you a very quick summary here. So what happens is that over time, the financial markets of a particular country become more mature. For example, in the past, you would have heard that India had Harshad Mehta scam, there was Ramalingam Raju, Satyam scam, etc. So this happened in 90s and early 2000s. Now, this is not a very far off period, because right now we are sitting in 2020s. And if you just go back 20 years back, a lot has changed in the Indian markets. So what I'm trying to tell you is that every markets get mature with time. Same has happened in the US, same has happened with European markets, same has happened with every developed countries. The law gets more stable, the accounting frameworks improve, and a bunch of improvement come into the mix. So the capital allocation of the company, or at least a profitable company, will improve with time, because they cannot do ghapla. Let me give you a practical example to prove that point. For example, if you go and speak with people from previous generation, one of the key things that they will tell you about the stock market is that, okay, there were companies, they were making a lot of profits. The founders of those companies were living very lavish lives, but that money never used to reach the stockholders. So that problem is going away from the Indian market. So therefore, I feel that investors in India are sitting on a cusp of revolution where the golden era for Indian stock investing might take place. So let me also show you some historic snippets to prove this point. So this is the story about Ramalinga Raju and how after Satyam scam, the accounting standards in India underwent a lot of changes. The corporate governance framework changed quite aggressively. Second, let me point you to this particular snippet. This is the Companies Act 2013. This is a major milestone as to how companies reported and have undertaken better accounting practices. And there are a bunch of different rules that have impacted the stock markets quite positively. Third and final thing, that SEBI has started to become slightly more aggressive in terms of its approach, which is a good thing, which prevents the interest of the retail investors as well. A classic case in point is the Brightcom group example. I had made the video about Brightcom somewhere last year, categorically stating that there is something off about the company, and I'm glad to see that SEBI took notice of that company and ordered a forensic audit of the company. Now, this might lead to a rhetoric question that, hey, Akshat, then why do you advocate investing in the US stock market? Are you not contradicting yourself? No. I talk about US stock investing and other countries investing simply because of the viewpoint that we must be diversified investors, because a lot can go wrong in terms of investing with any country, even if the fundamentals look really good. So that is from a diversification perspective. That's one. Second key thing, there are a lot of challenges that still persist in a country like India. For example, I have made several videos on how consortium banks and public sector banks are giving a lot of loans to big fat players. Now, these type of things need to be improved with time, and I'm hopeful that it will get improved with time and better risk management framework will come in PSU banks. Similarly, there is a lot of misinformation that is given out by leading news channel. There is a lot of stock manipulation that happens still. So all these are negative points, which I am hopeful will improve with time. But I hope that you learned from this video as to why capital allocation is very important for any business, why you as a stock market investor should be very cognizant about how a company is utilizing its capital. This $1 rule is sensible from that perspective. And finally, why India is on a growth trajectory and we must continue to believe in India's story. I hope you enjoyed the video. I will see you soon.